Since my college days, I have heard a lot about Enron. I've heard that it was a big, one of the most admired corporations, not only in the US but the whole world, and it eventually got destroyed due to some fraud. I heard mixed sort of stories about Enron. Some say that it was an accounting fraud, some say that the business practices were not really robust. So let us have a quick analysis and find out. So, why do we all think that Enron failed? Was it only the accounting issue? Well, let me take you all through some quick facts of the Enron case. Starting from the revenues, Enron reported revenues of 100 billion US dollars in fiscal year 2000. Its share price was all-time high at $90.75 in mid 2001. However, the share price fell below $1. In 2001, it got filed for bankruptcy. In the same year, 20,000 jobs lost, almost 3.2 billion funds in retirement and pension lost. On the contrary, the top executives cashed around $150 million through bonuses and stocks. Now imagine a top executive who has been responsible for all this Enron thing was able to move hundreds of $1 million. At the same time, a lineman, an electric cable lineman who was working in one of the sister companies, he wasn't able to move a dime. Now, this person would have spent half of his career in moving and fixing the electric cables. He wasn't able to move his money from his retirement or pension funds. Now, this was so wrong. Somebody committed suicide, shot himself due to the pressure in his head this whole Enron thing created. Now, this reminds me of this brilliant teaching in Islam, which is here. So yes, the main reason that Enron moved towards its failure was its business and accounting practices. That could further be drilled down to the arrangement of SPEs or special purpose entities, securitization of its assets, and mark-to-market system of accounting. Last but not the least is the incompetence on behalf of its board of directors. So basically what Enron did is that they created the SPEs or special purpose entities where they transferred their major liabilities or debts, and they didn't consolidate it as the consolidation was not required at that point in time in 2001. January 30, 1992, a celebration took place at 31st floor of Enron's corporate office. Well, it was not to celebrate some accounting profits or a budget meetup. It was for the approval of the mark-to-market accounting system. Mark-to-market accounting treatment is a way to value your assets at fair value rather than at historic cost. So what happened at that point in time that there was no active market for Enron's product, which was natural gas or electricity. So they were valuing their assets themselves. Enron was overvaluing its assets based on the mark-to-market accounting treatment, and nobody was challenging their calculations. The auditors? Well, the auditors got sunk in the sinking ship. They didn't audit properly. That's what happened. They were the internal auditors as well. Perhaps there was some conflict of interest. They were making millions from Enron. So, in a nutshell, they didn't audit properly. Finally, it was doing securitization of its assets to generate cash flow. Well, these were some of the business and accounting practices of Enron that ultimately led it to the failure. But who approved it? The board of directors. So was Enron's board really incompetent? Let me quickly show you the composition of its board. Yes, I hope it's visible to you guys. So these were all the board members of Enron committees, executive committee, audit committee, etc. You will notice that the board members were quite qualified and experienced individuals. For instance, if I mention about Robert Jedike, he was the professor of accounting at Stanford University, and he was the member of the audit committee. So what happened? How did the board approve such practices, such business and accounting practices? So, apart from the fact of the conflict of interest, there was something which is called as the Abilene Paradox. One of the interesting theories introduced by Jerry Harvey in 1974, a management expert. The Abilene Paradox refers to a situation where a group is likely to make a decision, a collective decision, which is counter to the individual preferences. The Abilene Paradox is likely to be driven if the individual believes that they will experience negative attitudes and feelings if they speak up on an issue. Obviously, if nobody speaks up, the group will collectively decide against individual preferences. Jeffrey Sonnenfeld, a professor at Yale University, studied the Enron case, and he specifically studied the board. And here is what he found. For the purpose of understanding, just consider me the accounting professor who was the member of the board. So CEO and CFO would tell to the board about the financial performance of the Enron Corporation, and nobody would ask questions. I, being the accounting professor, might have some questions about what was off the balance sheet, how the revenue was recognized, etc., etc. But I didn't ask any question because nobody else was asking. And I thought, if nobody else is asking, guess everything must be okay. Well, turned out it was not okay. What was happening was something that looked like sort of approved by the group. A groupthink was taking place at Enron. They were acquiescing. They were not asking questions. They were not inquiring. They were not asking the probing questions. This attitude resulted in the destruction of Enron Corporation. The lesson that I have learned from this Enron story personally, that I'd like to share is that if I am a member of a team, if I'm a member of a group, and if there's some matter under discussion, a task, or maybe an institute organization as a whole, and if I have some questions, and if I'm not asking out of shyness or whatever it may be, then I'm not doing justice to that team, that matter, or that organization as a whole. Guys, I hope this makes sense to you. It does to me, definitely. If you have any thoughts on this, do let me know. And please like, share, and subscribe. Thank you.